Portfolio Builder members, today is Wednesday, September 4th, and we have every single trade in our portfolio up today. The big news that hit the wire was that Hong Kong removed the extradition bill that China was imposing on it. They wanted it to be able to grab people out of the streets in Hong Kong, freeze their bank accounts, and bring them over to the mainland for legal proceeds that would be based on Chinese rule of law instead of a more democratic setup in Hong Kong. Regardless, this helped all of our trade. SPY is up, TLT is down. We were long the SPY and we were bearish the TLT. Surprisingly, our big position in gold held its spot in terms of its pricing and is continuing to grow, and the big picture remains exactly the same. So we'll go over all our trades in today's update. First, I want to just look at the most recent trade alert so we can see how we generated profits for retirement income through the SPY ETF. The SPY ETF is a electronically traded fund that represents 504 shares of, or rather companies, of the SP 500. So one share of the SPY diversifies your portfolio into all of the top American companies. Then we go take advantage of their options market, which has 3 expirations per week. No other security in the world offers that. So this makes a great opportunity to generate income every 48 hours. Monday, Wednesday, and Friday are your new paydays if you follow this program. So let's take a look at how we generated the profits today, what our total portfolio is looking like, and then jump into the news that is dictating our views of how we trade. Okay, so last Friday, the market was still a little crazy, and we weren't quite sure if all the turmoil in the markets was really over or not, but we were beginning to become bullish last week in stocks and went bearish on the TLT last Thursday, and the trade was going against us until this morning, and everything has flipped to be exactly in our favor. And so last week's trade before the long weekend, and we skipped Monday because the markets were closed, so we went from Friday through Wednesday with this trade. Our trade alert was to sell to open the 297 call option for a credit of 32 cents. And I was still pretty nervous at this point in time, so I bought a very expensive put option, the 289 put, for $1.17. This essentially set us up to have the SPY go up at least 86 cents just to get to break even. So we had a little bit of an uphill battle to generate profits on this trade, but my expectation is the SPY is going to travel rapidly back to $300 plus. And we'll look at why in a minute. So we don't want to miss out on these huge appreciations of the underlying asset. And so the trade alert from last Friday was as such. So it had the maximum risk of $400 if things did not go well over the weekend with Hong Kong's protests continuing, if there was bloodshed, if things escalated, we had downside protection. And the worst case scenario for us was if the SPY cratered over the weekend, we would walk away with $289 per share because we owned the 289 put. Now, on the other side of the coin, the most we could generate in profits would be cut off when the SPY hit 297. So I didn't really think we'd hit 297, and I really didn't think we'd hit 289. So we sold the call option for what I would say free money, 33 cents, to help finance that downside protection until we got confirmation that things were really going to ease. Now we're going into the 70th anniversary, celebrating China's capitalist revolution is kind of how they pitch it. And I was expecting that they would not want to rile up the world during this period of time, and that we would potentially have until around December 15th, when the next big round of tariffs hits, of gradual increases in equities. So that was the concept, the big idea. Let's just see how this played out and how we continue to play it in today's trade alert. So you can take note that at the time of issuing the trade alert, the last trading price on the SPY was 292.18 in this screenshot. And in fact, when we did the actual trade, it was at 292.16. So we go to today, and when we closed out the trade, we were trading at 293.32. So I can show you the screenshot of closing out the trade right here. Now keep in mind, you're not going to get today's trade alert in this video. That's only available to our paid members. So I'll give you a phone number in a minute to call to upgrade your account if you're not getting today's trade alert and you don't want to miss out. But you can see we're able to close out our short call for a penny, so we had to pay a penny back. Our put option expired worthless, and the trading price of the SPY is now at 293.32. So let's calculate the profit. It's really simple. The SPY went up $1.13 from 292.19 up to 293.32 for $1.13 gain. That's a nice profit, but again, we were really looking for a confirmation that the trade war would de-escalate for a period of time based on this celebration happening in China. And so sure enough, the protests in Hong Kong are dying down, and I believe we will have a period of rest, of peacefulness, until about December 15th. And around that period of time, I think there's going to be another heap of volatility thrown at us. So we'll talk about what our plans are for the next few weeks, how we're going to play this, and what could alter that point of view. On the other side are protection, the options. Sometimes the options are used to generate profits, but in this instance where we think the SPY is going to travel rapidly higher, it's easier to let the SPY pay you every 48 hours and use the options to protect against downside risk. So in this case, we had to pay 86 cents to put on our options, which was a long put and a short call. And then to get out of that, what we call a caller option, we had to pay another penny to get out of the short call. The put expired worthless. So unfortunately, we gave up a good chunk of the profits, but we went into the trade knowing that we really cannot lose much money at all, no matter what happens. We financed part of the downside protection by selling a call option that generated a 98% return. And we walked away with a clean 26 cents per share, or on 1,700 shares in our model portfolio, that's $442 of income over the last, and I did mistake in that this is a little bit longer than 48 hours because we skipped one trading period. But in general, we're doing this every Monday, Wednesday, Friday at noon Eastern. So this represents the return in our Monday, Wednesday, Friday trade. It's a quick trade, takes less than 3 minutes, trades the SPY. You need 100 shares of the SPY. That portfolio is now up 9.8% year to date and has been a very consistent bread and butter winner. So in your trade alert document, in your email, you can click on this link and it'll send you over to our spreadsheet where you can review all of our trades in each portfolio. So I'll jump into that in a minute, but that's our current return on the SPY ETF, 9.77%, and it's had a very clean return. In fact, if we look at the monthly return of just the SPY trades, we had a 0.8% return in August. We've had little trouble in July, and if you've been following me since June, you knew that I was calling for trade war escalations in June, expecting it to hit in July. It didn't hit till August. We got that out of the way, and now there's a pretty clear picture of what's coming towards us. And not to spoil it, but I think the SPY is going to break into new highs in the short term based on the Federal Reserve dropping interest rates and potentially a big thing happening in the bond market, which we'll get into in our macro view. So you can see we've returned 3% in January, 2.6 in February, 1.5 in March, flat in April, a losing month in May and July, only negative 1%. So we didn't lose much, made 3.4% in June, and I think August and September are going to be very, very profitable just by riding the SPY to new highs. So that's a review of that. And again, That's how you can track how to do these trades. Just to really simplify this for you, step one is you have to have 100 shares of the SPY. Don't do that until you get the trade alert, because it's important that you have protection. Now, these put options don't pay off often, but when they do, they can return 500, 900, 1,000% and completely take all the impact of sudden volatility spikes. So that is how you put on the most recent trade. You sell to open the call option. You buy to open the put option. Let's look at how we get out of that trade. Now, in this case, the put option went to a penny. We don't have to sell that because nobody wants to buy it for a penny. So all we have to do in this current trade alert is buy to close the 297 call option. Now, today's trade alert, again, you're not going to have access to in this video unless you call Dean and upgrade your account. So if you've had a free trial and it's expired, you're now getting this daily video without the trade alert in your document. So you get to see the results of the previous trade. You get to see what our big picture view is, which is very valuable in itself. But if you want to get the exact trade alerts, you need to call Dean right now at 505-322-7515. Activate your account so you can get today's trade, get tomorrow's trade, and really start protecting your portfolio and growing it. Okay, so that's a good review of our SPY trade alert, what we put on last Friday, how we generated a profit today. Let's take a look at our total strategy, because it's not just the SPY. In fact, we're currently recommending a few different allocations of capital, which can be summarized with 3 options. So if you have at least $100,000 to invest, here's how we currently recommend you allocate your capital if you want to take advantage of our trade alerts Monday through Friday. Now, I will provide some samples that take a little less work and a little less capital in a minute. And also, I do want to point out, if you have any questions, we have a live chat, so please feel free to ask questions throughout the presentation. I'd love to interact with you. Okay, so if you want to follow all of the trades, the best way to do it is to have 100 shares of SPY, noon Eastern, Monday, Wednesday, Friday. We're going to do a trade just like what I showed you. The options get slightly adjusted as our view of what the SPY will do changes. Right now, I expect the SPY to shoot up to above 300. So currently, we're using very wide collar. We're not trying to make profits from the options. We're just trying to protect the downside. As the SPY gets into nose bleeding territory with no reason to go beyond most likely 310 to 330 range, that's when we'll tighten the collar and even flip the collar upside down. So you'll note that we do generate profits from down moves in these assets by adjusting our options. And in fact, we're currently betting down on the TLT with our trade alert from Thursday, which was underwater yesterday until the newswire hit that the extradition bill in Hong Kong has been removed and bond yields spiked, bond prices went down, TLT is down, and now we have every single trade winning today. So again, if you want to invest $100,000 into what we call a weatherproof portfolio, you would have 100 shares of the SPY to trade Monday, Wednesday, Friday, 100 shares in Facebook for our Tuesday trade. Now remember, Tuesday's aiming for a much larger return, but it potentially takes on bigger risk and it can have bigger losses. So there's no free lunch, but if you do want to really juice up your returns, the Tuesday trade does that. And while the SPY is trading below 300, expect me to play Facebook at the current time. Once we get to 300 on the SPY, my intention is to rotate into a much safer security. In fact, arguably the most important security in the world, and that is Microsoft. And then once we get to extreme valuations in the SP 500, I'm talking above 310, probably around 315, expect for us to rotate into the silver ETF, expecting that Trump is going to get brave and start poking the Chinese once again. Now, meanwhile, the very important thing to do is to own 300 shares of the TLT, which is your 20-year plus U.S. Treasury bond ETF. This gives us the ability to play the rates market and balance out our portfolio. Typically, SPY goes up, TLT goes down. TLT goes up, SPY goes down. When you overlap your portfolio in such a way, it makes it extremely hard to have a losing period. And we'll show you what our overall return is when you overlap the strategies. We only have one losing month. Now, the last piece of the puzzle is to own gold. Sure, you can diversify this buy and hold 10% allocation, but right now, to really simplify your life, I simply like GDX. I like it more than GLD, spot gold ETF, because I believe the central banks will slowly but surely start putting a cap on what the valuation of spot gold is. And in fact, at $1,500, it's already pretty pricey. Now what people are figuring out is, okay, if the central banks are going to start capping off the price, who's going to supply new streams of gold? And of course, that's your gold miners. So GDX is the ETF that hits the big gold mining companies and is my favorite simplified play for playing the precious metals market. Now in a little bit, I'll show you how you could diversify that a little better, including what I would do with a 2.5% position of your total 10% position in Bitcoin and Ethereum. So we'll take a look at that. But for those of you who want to make life very simple, this is it. All you need to know is SPY, Monday, Wednesday, Friday, noon Eastern, quick 3-minute trade. Facebook on Tuesday, totally optional. This is going to increase the volatility of your portfolio, which in turn can increase or decrease your profits. So when the market's trending and we're predicting that trend, that Tuesday play will dramatically increase profits. When the trend changes and we are not expecting it, that's when that Tuesday play can have greater volatility. All in all, when you overlap the strategies, this simple portfolio is very, very hard to show a loss, especially when you're putting put options below the core assets and selling call options regularly for retirement income. Let's look at another portfolio allocation you could consider. So if you don't want to trade Tuesdays because it's too risky and you'd rather just own the much more diversified SPY ETF, then you would just own 100 shares of the SPY for Monday, Wednesday, Friday, and then 200 shares of the TLT for Thursday. Once again, you have a very balanced equity bond portfolio. You're still protecting the downside with put options under both of those assets, and you're still selling call options for consistent retirement income. This portfolio also has a 10% buy and hold position in GDX, as we really believe the central banks will be forced to lower rates and start buying up government debt, monetizing the debt. In fact, I'm going to show you so much proof that this absolutely is going to happen. It will blow your mind in a minute, and you definitely want to hold gold. Now, for those of you who like a little bit extra profit, don't mind a little extra risk, and you'd rather work much less, then you can get rid of the Monday, Wednesday, Friday schedule altogether, simplify your life, and just follow our trades on Tuesday and Thursday. You can do this for just under $40,000 with 100 shares of Facebook for the Tuesday trade, 100 shares of TLT for the Thursday play, and then buy and hold 115 shares of GDX. Again, same allocation, just less work, higher return. Again, when the market changes direction unexpectedly, that's when we can have greater drawdown on this Tuesday play. But when I show you the return of that Tuesday trade alert, it is very, very attractive. Now, again, on Tuesday, we're not just trading Facebook. I'm trading Facebook until the SPY gets to 300. Once we get to 300, we'll rotate into Microsoft. Once the SPY goes even further, or until we see signs of the trade war escalating, we'll rotate into the silver ETF. And at some point, I'm expecting China to deliver a serious blow to Apple. We had traded Apple earlier this year after it had a significant sell-off, made a lot of money with it. I would love to get back to Apple in a big sell-off. Now, I think the sell-off will be revolving around potentially Apple having to get out of China. Don't forget, they employ 1 million people in China to build their products. So this could be a huge blow to Apple in the short term, also a huge blow to China. But you got to remember, the pressure on their leading telecommunication company, Huawei, is not ending. In fact, it looks like that will probably be the next big thing Trump does. He's got the tariffs coming into effect. And at this point, I think it's just enough to rumble emerging markets, force them to devalue their currency. And you do the math. If there's more currency out there that's not denominated in dollars, it's going to make the value of all U.S. assets go up. And I'll show you proof that's exactly what's happening. The dollar is strengthening even as we have record deficits stateside. Treasury bonds continue to rise at all-time highs in terms of the TLT. And the same thing for U.S. equities. We're near the high. So we'll take a look at what I think happens next in terms of that trade war. But just keep in mind that Tuesday play will rotate the specific stock we're playing to take advantage of the current situation. Now, again, if you don't want to miss out on the trades, call Dean 505-322-7515. Activate your account. I try to provide so much value in this live stream that a lot of people can take the trades, get the basic idea, and beat my returns. In fact, Dean is one of those folks who's consistently taking the ideas and making it more aggressive and pulling home huge profits. So I do hope everyone enjoys their live stream. In terms of what my goal is, it's not to generate huge returns. In fact, it's to generate small, super safe, conservative profits with very little drawdown. And so that's what we have delivered. And in fact, when we overlay the strategies, you can see that we have a 1.2% return in December, a 2.2% return in January, 1.7% in February, 2.7% in March, 1.2% in April, 2.2% in May. June was our best month, 3.2%. July, a loss. This is when I had jumped the gun expecting Trump to raise the tariffs. We lost 1%. That's our only losing month. If you follow the program in its entirety, August is shaping up to be a very good, well, it's ended now, obviously, 2.3%. Now we're headed into September. So if you do go to your trade alert document, there's a link below the track record so that you can click around. And it's important to know there's tabs below. So if you want to see the exact results of the SPY, click on that tab. If you want to see the TLT trades, click on that. If you want to see the Tuesday trade, click on that. 19% return on the Tuesday play. And in fact, year to date, it's even better because it lost. So if I travel down to the Tuesday play, you can see the monthly breakdown. If we hadn't had the 4% loss in the Christmas massacre last December, this portfolio would be up even more. But year to date, excluding last December, 24.8% return. And this is not with getting lucky and taking on lots of risk. This is with always having put options below the security and selling call options. So the net result is we're ensuring consistent returns from selling the call option. We're giving up a huge amount of our profit by purchasing put options at all times. And by doing so, it makes it extremely hard for us to lose very much capital in any given trading period. The only way we could really lose is to get the big picture wrong for a long period of time. And as you can see, even when I did jump the gun and completely get it wrong last July, we only lost negative 1%. Okay, so let's jump into some news. And real quick, actually, I will show you my buy and hold portfolio. So here's kind of what I have in mind for our followers. Right now, I think that GDX is your best single position to play the gold market. Sure, you could buy SIV, a silver mining ETF, if you wanted to spicing it up. But again, I'm trying to make your life so simple, as few tickers as possible with the most diversification to weatherproof your portfolio with two major concerns. Number one concern is obviously the U.S.-China trade war escalating and the two countries decoupling, creating two different economic centers in the world, the West and the East, a democratic system and a communist system. And that looks, quite frankly, what will happen in the next several years. On the other side, we're worried about a U.S. recession. Sure, the rest of the world is starting to slow down and they're lowering their rates, printing money. The U.S. has not gotten to that point yet. Okay, so that's what our major concerns are. With the outlook that the central banks are going to dramatically increase the monetary supply in the next 12 months, primarily by monetizing government debt, this is extremely bullish for our precious metals and cryptocurrency portfolio. I like gold as the ultimate hedge for inflation from central banks printing money, but I also really like Bitcoin and Ethereum as somewhat of a rebel without a cause sort of anarchist currency. And I think there is a big place for Bitcoin and Ethereum without it having to overtake the dollar or any of that nonsense. So when you look at the market cap of Bitcoin and Ethereum, it's tiny relative to gold, and gold is tiny relative to the stock market. The stock market's tiny relative to the bond market. So this is an extremely aggressive 10% total allocation right now that we've grown over the past 9 months as the central banks have completely reversed course. Now, when we first started this, we were just long a couple cryptocurrencies back on December 12th, and it only represented 12 or 2.5% of our total portfolio. We were able to get into Bitcoin at $3,421, Ethereum at $88, Litecoin at $23, and Bitcoin Cash at $101. These made huge run-ups this year, and as the central bank began to go from autopilot quantitative tightening and rising rates to, well, we're going to pause. Now they've cut rates. Next meeting, September 18th, I'm expecting them to lower rates, and we've already seen them starting to buy the 10-year Treasury to the tune of $15 billion. So it does look like QE is headed our way in the next 3 to 6 months in a global scale. So as these events have turned out correct, we've gradually increased our allocation in this buy and hold portfolio. Now, I'm expecting the opportunity to short the equities markets sometime in December based on the SPY getting to new highs, China not giving in on anything we want with the trade war. If that happens, I'm expecting probably some major punches towards Huawei and other key companies in China, potentially even an attack on how they have listed their securities on the New York Stock Exchange and have an exemption from the Securities and Exchange Commission, allowing them to not have their companies audited because they say these companies are state secrets. So they do not allow any auditing of their companies, which is absurd, completely absurd. The best way to short the equity market without having to deal with complex options will be to build a portfolio of these 3 ETFs. And again, I don't think the time to do this is anywhere near. Most likely, the Fed's going to give us a dovish message in September 18th, which will push stocks dramatically higher. At that point, I will most likely double down this 10% portfolio to 20% so that we can get a nice position in Yang, the SQQ, and the SDAO. So these are all short products to benefit from a quick down move after we see everything rise from the next few months. Now, I could be wrong. The trade war could escalate much sooner, and so we'll be on high alert for that. But again, by having this portfolio allocation of stocks and bonds, it allows us to be surprised, to not suspect when exactly this will happen, and the bonds take care of business as well as the gold. So anytime trade war escalates, we're not ready for it. We want to have that bond and gold position ready to rise in value. So this simple allocation of your capital will make your life so much more simple for generating consistent retirement income. All right, so that's a review of our portfolio and our strategies. Let's take a look at the big macro news that's driving all these decisions. And we have 20 people watching now. That's a record. Welcome, everyone. If you do want to say something in the chat, we really appreciate it. If you can like the video and subscribe to the channel, that also helps with our rankings. We really appreciate it. 21 watching now. That's great. Okay, so let's look at the big news. Kyle Bass has really been the point man for delivering all the negative information on China over the last, really, he's been on this for much of his career. So he must be very happy to see this all happening. Big news is that, well, I'll read his tweet. Power to the good people of Hong Kong. The CCP, Communist Chinese Party, has just experienced how smart and peaceful crowds can overcome communism. Xi and Lam's weakness must be exploited to force the remaining demands to be met. The CCP just exposed their Achilles heel as we get closer to October 1st. And he's referring to, I believe, the Chinese big anniversary that they're celebrating. There's Carrie Lam. Okay, Trump tweets, the Chinese are very adept at not accepting anything. You've got to be very tough, and that's what Trump is doing. It's in China's interest to correct, and I think we'll end up with a solution that's dramatically better than we have today. Frankly, I think the impact of what Trump is doing to China is not lost on the rest of the world. Europe has had among the most protectionist policies forever. They're sitting there and saying, gee, are we next? Maybe you are. We've got to change the rules. The U.S. can't defend the world and pay for it. We can't have a system where we run our entire economy for the benefit of other countries, which have long charged us big tariffs. Don't keep ducking the reality. The U.S. has been subject to tariff terrorism for 50 years, but a real deal can be done. So the big question is, how much pain will China really take before giving in to some of the U.S. demands? I don't think they're going to change their government structure. The Communist Party does not want to lose their monopoly of slave labor. So that's probably off the table. What possibly could be accomplished in the trade war? The only thing I could really see the Chinese doing that Trump may give in to some degree to would be if the Chinese would purchase massive agricultural products. And we are seeing that they're having a food shortage. Their area is highly polluted. They have a massive problem with their food supply. So there's good reason for them to buy agricultural products. But they're not. Meanwhile, U.S. has their national champion Huawei essentially on life support pending all these sanctions, which continued to be delayed. So the only trade deal I could really see happening, at least before the election, would be something along those lines where China agrees to purchase farm goods and U.S. releases some of the sanctions on Huawei, maybe reduces some of the tariffs. And that's a big if. If you do look at what Trump's doing, he seems to be really focusing now on trying to force China into a trade deal. So that's what we're looking out for. Now, the big thing that's being circled around is, are the Chinese trying to put the U.S. in a recession so that they can get someone else to deal with in the 2020 presidency that would be more kind to China? And so that's a very good question. How much pressure can Trump really put on China without causing all the damage that's happening in emerging markets to spill over to the U.S.? So far, so good. So that's a very questionable thing. This little tweet's just talking about how strong the economy has been under Trump's office and how he's most likely to win the election next year. And again, that's as long as we don't go into a recession. Meanwhile, we are seeing some bounces in PMIs in China and Australia. which is all pointing to our concept of a very bullish stock market in the short term. And you can see, because of the global PMI dipping so low, and this is not in the US, we did have one print that was negative yesterday, but overall the US is remaining strong as emerging markets around the world are dramatically weakening. And so this chart shows you that. Here's a list. I'm not going to read everyone, but we've been talking about this. China has been devaluing their currency, which is causing every other country around the world who does trade deals with China to also devalue their currency. At the same time, this makes it harder for them to pay off their debts, which are all denominated in dollars. So they have to print money to pay their debts. As the monetary supply increases around the world, at the same time as the U.S. staying pretty much stiff, just barely loosening monetary policy, we're seeing the dollar strengthen, we're seeing the U.S. bond market strengthen, and we're seeing U.S. equities trade near all-time highs. And this is at the same time that emerging markets are very suppressed in prices, their currencies are devaluing, and they're lowering interest rates. And so this just goes through what's happened just in August around the world. Rate cuts everywhere. And so this trade doc is linked to in the description box if you would like to check it out and read this in detail. But you can see this is a worldwide phenomenon. Everywhere is dropping rates and gearing up for QE. Okay, so you can see it just goes on and on. They're all collaborating to do the same big move. Here's a chart about how long until a recession. Just shows how long you have an inverted yield curve until you get a recession. And you can see it takes a long time. And the reason why is because when the yield curve inverts, typically rates get dropped, quantitative easing starts up, and you get another big push to the upside, which is what I'm expecting exactly right now. And the caveat is I think around December, there will be no progress in the trade war, and with no progress in the trade war, we're probably going to see Trump escalate this and give us another big sell-off. So that's kind of our expectation. ECB had been hinting about a bazooka, is their wording, of stimulus coming. So we'll see if that really comes to truth or not. And also, I'd be shocked if the Fed does not at least drop 25 basis points September 18th, maybe 50. And it's interesting to see how much bonds they're starting to purchase. Here's the interesting timeline I found on the U.S.-China trade war. You can see it's just been a gradual increase in tariffs. And it's been the Chinese just dragging their feet, pretending they're going to do a deal, and nothing ever happens. So if you want to go through this, you can see the slow but gradual escalation. Trade war gets real for Huawei. Also, good reminder of how few protection laborers have in China. Okay, so we have the Huawei CEO saying this is a live or die moment. They're starting to try to re-employ people into new parts of the company. Again, the biggest problem for China is trying to keep all these people employed. So they've been building massive infrastructure and housing projects that are not being used. They've been creating massive debt. And with all this pressure on their economy right now, can the scene that happened in Hong Kong start to happen in mainland China as people have worse and worse living conditions? That $10,000 a year income they're used to starts to slow down at the same time as massive inflation hitting their food markets. So this is looking very troublesome for China. Xi Jinping urged the ruling Communist Party to brace for a long-term struggle against a variety of threats, including the economy, defense, Hong Kong, and Taiwan, that would last at least through 2049. China's development is entering a period when various risks and challenges are emerging together. So it does not look like either party is going to budge much at all. And again, the only thing I could really see happening in the short term that would be bearish for our bonds and for our gold would be a small truce between U.S.-China, where China agrees to support the farmers, which Trump wants because it'll help him win the 2020 election, and he can at least put the trade war on a less escalated level going into the election. So that's what I'm on the lookout in terms of the SPY being able to get above 315, 330. Otherwise, I expect that Trump will lose his temper and start poking China once again. Policy uncertainty in the U.S. Is at nearly all-time highs. We're getting a very mixed message out of the various Fed speakers. The bond market's demanding huge rate cuts and essentially QE to bail out all these bond speculators without crashing the U.S. bond market. And at the same time, we're not getting that kind of forward messaging from the Fed yet. So very interesting. That could be a huge shocker for both U.S. equities and bond markets if the Fed were to be too hawkish come September 18th. Now, based on what all the other central banks are doing, I highly doubt that. But that's one reason you got to have the put options under both the SPY and the TLT. That single event coming September 18th could easily cause both the stock and bond market to rapidly sell off, including gold. Every single part of our portfolio could deteriorate if the Fed was too hawkish come September 18th. So something to look out for. I highly doubt it. You just saw how every central bank around the world is lowering rates and starting to pump money into their economy. So I doubt that the U.S. won't follow suit. Next chart I have, under pressure, industrialized countries will feel the heat of Made in 2025. And it shows how a lot of our better trading partners are being protected outside of South Korea. China Vice Premier Liu says hopes the two sides seek common ground. Okay, so they're having trouble getting a meeting set for September. And again, it does not look like China wants to do a deal. They may need to buy some farming goods just to give themselves a little less heat on the trade war. But in the long run, I don't see them caving into 90% of the demands that the U.S. has. Extraordinary charts. While the U.S. government doesn't have any negative yielding debt, U.S. companies have issued debt in euros, kronas, and francs trading with negative yields. Okay, so we can take a look. $230 billion of negative yielding corporate debt. Again, this is what's fueling the U.S. stock market. And we'll look at some charts that will give us a better heads up. But you can see, here's a list of all these companies who are pulling in loans that pay them money. Imagine getting paid to borrow money to buy back your own stock. Quite insane, but that is the world we're in. And I don't think the bond market's going to give in until the central banks start to essentially cash out all these highly profitable bonds that people have been sitting on all year. Just a funny tweet from Zero Hedge. Stick with the SP 500, if only for stock dividends, Bank of America says. And so they say, so stocks for fixed income and bonds for capital appreciation. Thank you, central banks, which is funny, but that is the world we're in currently. Everything's working in reverse. UBS cut China's 2020 growth forecast to 5.5 from 6.1 in early August. The second cut in less than a month, expecting the PBOC to further cut interest rates this year. So we can see the pain is starting to hit China. Facebook is trying to create their own cryptocurrency called the Libra. It's essentially just a basket of fiat currencies that are hedged. It's huge. I think it can really have great value around the globe if they can get this approved. So we're closely following that. I like Facebook in general just because they have an absolute monopoly on their products and they really have no business in China. So the trade war in China doesn't affect them as much as it does companies like Apple or anyone manufacturing or selling inside of China. Okay, Alibaba has all sorts of news coming out, but remember, we cannot audit Alibaba. We just have to take them for their word, which is not very trustworthy. But we're seeing a bunch of news feeds coming out about how strong Alibaba is, and their earnings are crushing it, which would support that the Chinese domestic economy is still strong. But what's going to happen when all these manufacturing jobs leave and never come back? What's going to happen as inflation rises throughout the Chinese economy and they can't continue to stimulate with more and more credit because they're already at a 300% GDP. So it does look like China is going to have some trouble ahead. Here's a look at the key stocks I track. Everything's up today except for the TLT. Here's the SPY chart, and I do suspect SPY is headed towards above 300 by the end of September based on that FOMC meeting. TLT sitting here at highs. We've been long the TLT all year, using it to essentially take out the shocks of tariff and trade war escalations. So every time that escalates, the TLT climbs to a new high, which has helped balance out our returns with the SPY. Facebook's our current Tuesday trade, and I believe it will pop up to 204 range right as the SPY gets back to 300 range. GDX is our favorite gold ETF, the gold miners, not the spot gold. Surprisingly, despite the de-escalation and sell-off in the bonds, GDX remains strong, indicating that there is the belief from investors that there will be a long-term demand for gold production. And so GDX can run up significantly faster and higher than the GLD ETF if that is the case. Here's the Chinese and emerging market ETFs I keep look at. This is a good leading indicator for us to predict trouble ahead in our SPY position. Everybody's focused on China, but at the same time, we need to keep careful eye on Deutsche Bank and HSBC, two critical banks in Europe that have been suffering because of low interest rates in Europe. Perhaps the most important conversion rate or exchange rate is the yuan against the dollar. And you can see as we de-escalate, the conversion rate is improving, showing that the Chinese are not escalating the trade war right now. But over the month, it did devalue about 5% to help offset the tariff costs. And if we look at the big picture, you can see the conversion rate has never been this poor for China. The other important conversion rate is the euro into the dollar, which has been consistently weakening for all of 2018 and 2019, which again points to the picture of a strong dollar, a strong U.S. bond market, and a strong U.S. stock market. Crude oil, I don't want it to be too expensive, which may create inflation pressures and force the Fed to raise rates. In the same breath, I don't want to see oil prices too low. That means oil companies can go bankrupt and that the growth story is dramatically slowing down. So this helps us have a good gauge as to be long the SPY. There's gold at this crazy level, 1537. I think GLD and spot price of gold can travel higher, but I would suspect the big central banks will start to put a cap on the total price or the maximum price, and that will help drive up the demand for the producers of gold, the mining companies. Here's a look at silver chart. For those of you playing silver, be careful. It goes up fast, but it also goes down fast. We'll be trying to take advantage of this in our Tuesday play when we can. We have used it recently and caught a lot of this recent move. The German 10-year bond is what I'm using to try to get an idea of what the U.S. federal funds rate will do in the future meetings. So we can see some relief in terms of bond prices selling off a little bit over the last 3 days, which helps support our idea that stocks are going to rally, which they have. The bigger picture of the 10-year is still a downward slope. And until these central banks aggressively come in here, start buying up all these bonds, letting the speculators exit with a profit without spiking the yields, I think that's the event that they're all waiting for. This is huge money that has piled into these negative yielding bonds, something like $17 trillion that needs to exit. They know they can't just sell it without causing the bond market to collapse, so they need the support of the central banks to get out of these positions. For now, they're trapped and continuing to drive these yields lower and lower to the point where the German government is getting paid to borrow money because their credit is so bad that investors believe their central bank will have no choice but to buy out all this speculation of bonds and to peg their interest rate. So it's working exactly the opposite. Usually people with bad credit have to have a high interest rate, not a low interest rate. But that's the world we're in right now. So that's a wrap of today's presentation. If you don't want to miss any trade alerts, please call Dean at 505-322-7515. Activate your account. This way you'll get all the trade alerts. We have a paid member webinar starting in 1 minute. So I got to get off this and start that up. So thank you all for your time. And if you are a paid member, we'll see you in the Zoom webinar next. That's where you can talk out loud with me and we can talk the markets and strategy. Thanks.